Hello, I'm Gary Korolev with Sovereign Wealth Management. Today we'll discuss where we are in the investment cycle. And a great way to look at where we are in terms of what kind of investments may potentially do well and outperform others is looking at the four economic quadrants. Stagflation, when you have high and rising inflation and low economic growth. Inflationary boom, when you have high inflation and also high economic growth. Disinflationary boom, when you have low inflation or a deflationary environment with high or with positive economic growth, which is what pretty much we had been until we hit the COVID crisis a couple years back. And then of course, we have the deflationary bust, which is something we went through during the financial crisis of 2008. Let's just keep it very basic today and go over a few data points which are very important in helping us figure out where we are right now, and based on that, how do we make portfolio decisions. So inflation. Where are we in terms of inflation? Of course, many have heard and have felt that inflation is getting to be extremely high, highest it's been in a very long time. Well, of course, as you may have heard, right now inflation is kind of setting new multi-decade records. Energy, of course, being the leader, being up 34.6% year over year. Okay, so if we look at the current inflation rate, all items 8.6% year over year. If we look at just energy, of course, 34.6%. That's the biggest contributor to the rising inflation rate. So out of those factors, inflation and economic growth, you can see that inflation is putting us in these four quadrants and in this area. So we're certainly not talking about being in deflation or disinflation. We're going to be somewhere up here in terms of those numbers we just saw. If we look at liquidity, liquidity is how easy is credit to get, because if credit flows easily, then companies can borrow, consumers can borrow, and the economy grows much quicker, as we saw with what happened post-March 2020 with COVID. The government was guaranteeing lots of loans. Banks were freely lending because of that. There was a lot of stimulus checks, so that's liquidity, and it went straight into the market. Well, as you can see right now, the Fed funds rate, or the interest rate, the basic interest rate of the economy, which is set by the Federal Reserve, you can see that it has gone up, which means money is much more expensive, and it's likely to continue to go up, which means the liquidity, which is one of the most important factors in how confident the market feels about the economy growing and so on, is rising dramatically. Okay, so right now, we're at 1.75%. So that's telling us that while we're still in this upper half, somewhere in the inflationary area, because we have a higher, more expensive money supply with reduction in liquidity, we're likely kind of starting to dip down into this area here towards deflationary. Now here's a pretty complex chart. We'll try to just keep it as basic as possible, but all three lines are important. So the dark blue line here is the U.S. non-manufacturing purchasing managers index. So when you have purchasing managers, people in charge of making big purchases for businesses, obviously that tells you something about the future of the economy. So what you can see is we had a big rise and a peak in November 2021, and then we've had big drastic decline. Now the index is still at around 56 at this point, so it's not in the recession territory yet, but the steepness of the decline has us worried. We also have the orange line here, the Federal Reserve Economic Conditions Index. And you can see here that, and this number works, this chart, this orange line, it works in reverse. So when it goes up, those are tightening conditions. So you can see here was the rise into March 2020 with COVID. Now you can see we had a steep decline when economic conditions improved, and now we're seeing a big rise again, pretty drastic. And you can see that it portends that the market is really starting to, or the economy is really starting to get tighter. Now, the light blue line is an index of leading economic indicators. So they tend to be pretty accurate in letting us know what the economy is going to do in the future. So as you can see, they've had a big drop into the big severe recession that we had, very short recession we had, but very severe one with COVID. And again, we had a peak in these leading economic indicators in May of 2021, and then we've seen a steady decline since then. Okay, so that is telling us that we are also starting to move towards slowing economic growth on this side here. Now, you are likely aware that the Fed gets pretty edgy about the markets, but the main concern that the Fed has, what it's always afraid of, is a runaway inflation. It's afraid of that as much as very bad deflation. Now, in the past, when the markets dropped 10 or 20%, the Fed just backed off of all its tightening, no matter how tough it talked before that drop. And because inflation was so low, they could barely get it up to 2%. You had the Fed not being nervous about having an easy money policy and flooding the market with liquidity because inflation was low. Well, now inflation is very high, as we discussed, and the main concern that the Fed has is keeping inflation under control. So now the stock market and how well it does takes a distant second place to getting inflation down. Now, why am I showing this unemployment rate? Because unemployment, or keeping unemployment very low, is one of the Federal Reserve's mandates. And so at this point, the feeling is, or the consensus is, the Fed, instead of worrying about what the stock market does, they are mainly going to be concerned with unemployment rate. And as long as the unemployment rate is very low, meaning people are employed, everybody that wants to work is working, then the Fed is going to feel good about continuing to tighten economic conditions. Now, the unemployment rate is actually a lagging indicator. So as you can see, every time, so these gray areas here are times of recessions. And as you can see, the unemployment rate was at its very lowest point in the cycle right before a recession. So it's a lagging indicator. So what this tells us is we have very low unemployment rate, and it's likely that a recession is coming soon, especially if you have all of this tightening going on, right? So where does that put us on this chart? So if we talk about where we are in the employment cycle, and we talk about where we are in the liquidity cycle with the Fed tightening, where we are with economic growth, that really is taking us from where we were here, inflationary boom, maybe 8 months ago, to here with stagflation, slowing economic growth, high inflation, and eventually likely into the deflationary bust. Okay, so what kind of investments are likely to do well in this type of environment? Well, definitely not high risk investments. So that's why in our portfolios we've reallocated more towards conservative assets, having a lot more cash in portfolios, having more commodities, But cash is the main kind of anchor in the portfolios right now, because while we've had a big pullback in the market already, you're likely to, there's high potential for that for that higher volatility and a sell-off to continue as long as we have tightening liquidity in the market, we have higher rates, we have a slowing economic growth, we have persistently high commodity prices, which are driven by a lack of supply. And that's not something that the Fed can really do much about. They can deal with financial assets. They really can't control what essential commodities like energy does, and food or agricultural commodities do. So if we look at actually what inflation expectations are, expectations right now from the market, from the big money, so to speak, from the smart money, is that the Fed will keep raising rates while about 6 months from now they will stop and they will have to start lowering rates again because conditions will get so bad in the economy that they have to reverse. And that's why we've had a yield curve flattening recently, where future rates are not really going up, or maybe even coming down slightly, while near-term rates on bonds, inflation on bonds have gone up, reflecting what the Federal Reserve has done with raising rates. But future rates haven't gone up as much, so you're not getting that big term premium because the market feels that the Fed is going to be pretty well able to control inflation in the long run. So we've actually slightly lengthened duration in our bond portfolios, extended that duration, because if you have tightening financial conditions and inflation may actually be at this point, while it's high, it may be leveling out and potentially going down somewhat. That's actually good for bonds relative to stocks. And certainly don't have to bet the farm on it, but that's maybe the second best position as long as it's reasonably sized in portfolios next to cash. So that's our overview here in the short run. And if you have any questions, if you'd like to talk with us, you can reach us at the information which will follow. Please give us a call or email. Thanks.